Right now, the biggest financial breakup in modern history is happening. The United States and China are about to split in the banking world, just as the war continues to divide both countries. This could mean billions of dollars in lost business. US lawmakers have told big American banks to stop working with Chinese companies. But some banks, like JPMorgan Chase and Bank of America, are ignoring the warning. Why? Because they badly want to participate in the stock listing deals that are being financed by China. The deal is with CATL, Contemporary Amperex Technology, the biggest battery maker in the world. They don't just sell to Chinese companies like BYD, but also to American giants like Tesla and Ford. Meanwhile, Trump and his Treasury Secretary Scott Bessent are seeking ways of crippling the Chinese economy, which has not worked so far. So, will this new strategy of blocking US banks from dealing with China work? With so much at stake, the outcome is unlikely to be as simple or favorable as the Trump administration hopes. What is interesting about all these is that Scott Bessent claims that China is reaching out to the US for a deal. But under oath, he could not confirm any specifics to this effect. If you are not subscribed to the channel, please do so, and let's get right into the details of this news story. For many years, the US and China were deeply connected through trade and investment. But now that connection is breaking apart fast. What started as a trade fight is turning into a complete financial separation. The US and China are not just moving factories or adjusting tariffs, they're cutting off investment ties altogether. When President Trump announced a new and aggressive economic plan in April, he expected to stop American money from going into China and instead push it toward patriotic investments at home. His administration rolled out major changes: high tariffs on Chinese goods, big tax cuts for US companies, and more relaxed rules for Wall Street. Trump says these moves will bring back jobs, boost American manufacturing, and make the US the top place for global investment. But here's the issue with this. Can America grow its economy while cutting itself off from China, the world's second biggest economy? China now provides almost 30% of the growth in the global economy. It's hard to imagine Wall Street giving up access to that kind of opportunity without a fight. If the US blocks banks from investing in China, what happens to American financial power? While US politicians talk about cutting ties with China, American banks are doing the exact opposite. JPMorgan Chase and Bank of America are now helping a major Chinese company, CATL, raise $5 billion by selling shares in a US public offering. This isn't just any company. CATL is the world's largest EV battery maker, holding nearly 38% of the global market. Based in Ningde, China, it supplies advanced lithium batteries to global giants like Tesla, Ford, and GM. Tesla, in particular, relies on CATL for batteries used in its Shanghai Gigafactory. CATL's battery production is enormous. In 2023, it produced over 400 gigawatt-hours of batteries, enough to power millions of electric cars. And it's still growing. By 2026, it plans to more than double that number to over 800 gigawatt-hours, which could supply batteries for about 10 million EVs every year. While most of its factories are in China, CATL is also building plants in Germany, Hungary, and Indonesia. It has even considered opening factories in North America, although political tensions have slowed that down. So while US leaders talk about reducing the country's dependence on Chinese technology, CATL's move into US financial markets tells a different story. Essentially, Congress is angry. Lawmakers from both parties are demanding that these banks back out. But Wall Street has its reasons. The US IPO market is struggling, down 72% in early 2025, while China's markets are booming. The Chinese central bank announced measures to ease 1.2 trillion yuan into the economy, cut bond yields to under 2%, and encouraged massive investments in technology and green energy. Wall Street needs deals to make money. Right now, the best deals are coming from China, not the US. If Wall Street won't stop investing in China, we have to wonder if the government will punish American banks. While US banks are helping CATL, they're being cut out of other big deals. One example is Chery Auto, a top Chinese EV exporter. Chery is raising $1.5 billion through an IPO in Hong Kong. But no American bank is involved. Only Chinese and a few Middle Eastern banks are participating. Chery sells cars in Russia, Central Asia, and Latin America, places where Western car companies have pulled out. This isn't just about lost profits. It shows that Chinese companies no longer need Wall Street to raise money or grow. China's local banks are offering better deals and fewer political problems. On top of that, the Chinese government gives companies tax breaks for listing their shares at home or in Hong Kong. Chery's IPO sends a message that American banks are becoming less important in global finance. But things could get worse. Imagine a situation where the Chinese government takes it a step further and decides to stop all Chinese companies from listing in the US. Could that crash the NASDAQ? Let's look at the numbers, and they're alarming for Washington. As of 2025, 4 of the 5 largest banks in the world are Chinese. The biggest, ICBC, holds $6.3 trillion in assets, nearly twice as much as JPMorgan. Together, China's top 4 banks control over $19 trillion. China's stock and bond markets are now worth over $25 trillion. Beijing is slowly opening these markets to foreign investors, especially in areas like green energy, AI, and semiconductors. Even European exchanges like the London Stock Exchange want more Chinese companies to list there, seeing weakness in the US market. The impact is huge. If US banks can't work on deals in China or Hong Kong, they'll miss out on some of the most profitable parts of global finance. And as China builds closer relationships with countries in the Middle East, Africa, and Central Asia, it's creating a new financial system that doesn't include the US. This split between US and Chinese finance is already happening. In April 2025, the US Treasury updated plans to delist Chinese companies from receiving American investment, saying they were national security threats. At the same time, China passed new data laws that force foreign investors to keep all user and transaction data inside China, meaning US regulators can't see what's going on. With this, it is clear that the age of shared financial rules is over. Now the world is dividing into 2 financial groups. One is led by the US, focused on transparency and free markets. The other is led by China, focused on government control and financial nationalism. Developing countries now have to choose: stay with the US and the dollar, or shift toward China's system and the renminbi. This brings up a hard question for American banks: whether it is worth staying loyal to Washington if it means giving up half the world's financial markets. If they can't compete globally, they may shrink into regional banks while Chinese banks grow bigger and stronger. What these government restrictions are leading to is confusion among American businesses. They can't plan for the future because no one knows what the government is going to do next. The usual method companies use, called forward guidance, where they estimate future sales and costs, has broken down. Why? Because President Trump's trade rules keep changing suddenly. For example, the CEO of Ford said he expects high tariffs to last at least 3 years. That means higher prices for the parts needed to build cars. And when prices go up, consumers stop buying. Across the country, companies are pulling back. Business investment is dropping, and consumer confidence fell 11% in April 2025. The biggest one-month drop since COVID-19 and the second lowest level since 1952. Companies are holding on to their money because they're afraid of what might happen next. Trump's team keeps repeating a slogan: 90 trade deals in 90 days. But within the US Trade Representative's office, there's chaos. Key staff are quitting, and policy memos change daily to match the president's shifting opinions. While the US stumbles, China is staying calm and moving forward. When Trump raised tariffs on Chinese goods, many expected China's trade to slow down. But that didn't happen. In just 1 week, Chinese ports moved 6.7 million shipping containers, 7% more than the same time last year. How? Because China prepared for this. They've built strong trade relationships with countries outside the US, like in Europe, Southeast Asia, the Middle East, and Latin America. Trump's tariffs were meant to pressure China. Instead, they've made life harder for American consumers. Prices are rising fast as most products in retail are from China. Meanwhile, China is helping the world by exporting cheap goods, which actually helps lower inflation globally. According to the International Monetary Fund, IMF, Chinese exports slightly reduced worldwide inflation, while American policies added to it. As a matter of fact, Chinese exports have been increasing throughout 2025. In April alone, it went up over 9%, which is proof that the US tariffs are only creating new export opportunities for China. In the past, the US was seen as the dependable global leader. But now China is taking that role. They offer steady prices and supply chains that work, even during global uncertainty. Many countries are starting to rely more on China and less on the United States. Politicians keep talking about reshoring, bringing manufacturing back to America. But in practice, this idea is failing. It sounds great in speeches, but the numbers tell a different story. Let's look at the iPhone. Making an iPhone in the US would be incredibly expensive. A recent report from Bank of America shows that the price of a US-made iPhone would be 90% higher. That would push the cost of a basic iPhone close to $3,500. Why? Because many of the parts come from other countries, especially China. The US simply doesn't have the raw materials, cheap labor, or the factories to do it all here. Also, America is facing a major workforce problem. The average age of a US factory worker is now 47. Many skilled workers are retiring, and younger people aren't filling those jobs. While China leads the world in using robots in factories, the US still imports many of those robots from China. Trump tried to create patriotic manufacturing zones with tax breaks, hoping companies would open factories in the Midwest. But the plan is failing. These zones have received only a little of the investment they were supposed to get. And many of the few factories built are still using Chinese parts. This policy isn't just a diplomatic mistake, it's an economic disaster. By refusing to talk, the US is making it nearly impossible for American companies to operate in the global economy. But we must be clear that the split between the US and China isn't just about products. It's about money, too. One big warning sign came when Chinese tech giant Alibaba held a $9.3 billion IPO in Singapore instead of New York. That used to be unthinkable, but now it's becoming common. So far this year, Chinese companies have raised over $38 billion in stock sales without touching American markets. At the same time, China's banks are growing rapidly. The yuan is also spreading fast, with global use rising significantly this year. China has created its own financial network called CIPS, which now handles over $340 billion in trades each month, without using US dollars. Meanwhile, the US is in trouble. Fewer foreign investors are buying US Treasury bonds, so American banks are being forced to buy them instead. This could lead to the Federal Reserve restarting money printing to keep the economy afloat. That would cause even more inflation. Other countries are starting to move away from the US dollar. The European Union is making direct deals with China. Middle Eastern countries are asking to be paid in yuan instead of dollars for oil. Even Japan is testing how to use China's financial system. It's clear that China is rapidly gaining ground in global finance, and Washington's efforts to block that rise are falling flat. Could Beijing soon overtake Wall Street as the world's top capital hub? The numbers suggest it's not just possible, it's already happening. And if America keeps pushing Wall Street away from global markets, China might not just catch up, it might leave the US behind. So if you want to stay ahead of this global shift, don't forget to subscribe and watch out for our next deep dive into the changing world economy.